Okay, this video covers the capitalization of software costs, which is which way do I point? This way or this way? What these people are doing over here is they're developing software, and it costs money to develop software. The question is, can companies capitalize those costs as a long-lived asset? Or do companies need to expense those costs? So these people are earning a salary. We credit cash when we pay them. Can we debit an asset account, or do we have to debit an expense account? Does it qualify as a long-lived asset? Okay, I think I've explained that enough. And so now let me move on to the rule. And I think I need to make myself smaller here. Now I'm smaller. And here's the rule. And the answer is you can capitalize software development costs, which are the costs associated with the development of software. And the key moment that you can start capitalizing software development costs is called technological feasibility. And I'm not a software developer, so I don't really know what that means. But here is what the definition is. You've met technological feasibility when the company has completed all of the planning, designing, coding, and testing activities necessary to establish that the product, the software, can be produced to meet design specifications. And this can be software for internal use or for sale. And so here I have a timeline for you of the software development process. And it all starts with when you begin coding the software. And from the time that you begin coding software until the time that you reach technological feasibility, you must expense those costs. So the software is too uncertain. We don't know if it's going to be successful enough to be a legitimate piece of software in the future. And because it's so risky, it doesn't actually meet the definition of an asset. The definition of an asset is a probable future economic benefit. And the software isn't a probable future economic benefit until it's reached technological feasibility. So you expense costs from when you start coding to when you reach that point. Then after technological feasibility happens, you can capitalize all of the costs that you're incurring to develop the software. So free foods in the kitchen, I think, would probably qualify, at least if they're for the software developers salaries, all of that stuff can be capitalized until the point that you're finished coding and you're ready for using the software. So the software is out of its development phase. And once the software is out of its development phase, it's that asset balance on a balance sheet, and you begin amortizing or another word for that is depreciating that asset into the income statement. So you expense costs at the beginning, then you capitalize costs in the middle, and then once the software is totally developed and ready to go, you've got that asset balance with all the costs you've capitalized, and you pick a useful life for those costs, and you expense those costs into the income statement over the software's useful life. That's the accounting rule. Now let me show you an example of this in practice, and we'll go through Salesforce. So Salesforce has a lot of people dedicated to software development, and here's their balance sheet. So this balance sheet's in millions, and they have a line item on their balance sheet called capitalized software net. And the balance in this as of January 31st, 2019 is $152 million. So that is the net. So net means net of amortization. So this balance is continually getting new costs added into it and also continually being depreciated. It has an accumulated amortization contra asset account stuck to it. And what you're showing here is the net between the gross capitalized software balance and the accumulated amortization balance. And that net balance is 152 as of January 31st, 2019. So that's Salesforce's capitalized software balance. And if you wanted to know more about this balance, you would go down to their footnotes. Maybe you could Control F for capitalized software. That's what I did. And what I found was in their first footnote, which is the summary of business and significant accounting policies, they have an accounting policy here for capitalized software costs. And here's the policy. The company capitalizes costs related to its enterprise cloud computing services and certain projects for internal use incurred during the application development stage. Costs related to preliminary project activities and post-implementation activities are expensed as incurred. So in other words, before technological feasibility, they expense costs. And after they're finished with the software, if there's any other tweaks that they're making, they expense those costs. Internal use software is amortized on a straight line basis over its estimated useful life, which is generally 3 to 5 years. So 3 to 5 year useful life on the software that they're creating. Management evaluates the useful lives of these assets on an annual basis and tests for impairment whenever events or changes in circumstances occur that could impact the recoverability of these assets. So that's just talking about maybe they need to impair the software. So if they have a 3-year useful life on a piece of software and they stop using it after 2 years, they would likely impair that asset value down to 0 and recognize all of the asset value as amortization expense in that impairment period. So that was the accounting rule for capitalizing software development costs, and an example of a company doing that in Salesforce. So I hope you enjoyed that video, and I'll talk to you next time. Bye-bye.